What is happening, crypto fam? Get ready to dive into the most electrifying updates hitting the market right now. The pace of news is absolutely insane, and if you're not plugged in, you're missing out on the biggest moves. We've got seismic shifts that could redefine the landscape, major debates igniting, and price predictions that will have you on the edge of your seat. This is the intel you need to stay ahead. We're breaking down everything you need to know, so buckle up. You're about to get the ultimate rundown. Don't miss a single second of this action-packed episode. Let's go. First up, we're tracking a fascinating synchronized flight between Bitcoin and gold, signaling potential macro uncertainty on the horizon for 2025. What does this unusual correlation mean for your investments as we navigate evolving economic currents? We're digging deep into the implications of this dual asset movement that could be a major indicator for the year ahead. Then, prepare for a deep dive into a heated ideological split within the Bitcoin community itself. The debate is raging. Is Bitcoin money or data? With a major upgrade on the table, we explore how this could fragment the network and what it means for the future of decentralized finance. This is a crucial conversation you won't want to miss. And that's not all. We're also analyzing the shifting institutional narrative between Ethereum and Bitcoin ETFs, dissecting whether a new wave of demand is on the horizon. Plus, we've got the latest price predictions, with analysts debating if oversold signals could be the catalyst for a massive rally. Stick around for all the essential insights and make sure you're subscribed and have that notification bell on so you never miss an update. Let's get into it. The Great Divergence, Bitcoin and gold's unprecedented sync. In a move that has financial analysts and investors buzzing, Bitcoin and gold, two assets often seen as distinct indicators of economic sentiment, have begun exhibiting a striking synchronized flight. This unusual correlation, observed as 2025 begins to unfold, is being widely interpreted as a potent harbinger of significant macro uncertainty. What does this parallel movement between a digital asset and a traditional safe haven truly signify for the global financial landscape? And what should investors be watching for as this trend develops? Historically, gold has been the go-to asset during times of geopolitical turmoil and economic instability, acting as a store of value and a hedge against inflation. Bitcoin, while younger and more volatile, has increasingly been viewed by a segment of the market as a digital store of value, often dubbed digital gold. However, the simultaneous surge in both assets, rather than a divergence where one might typically rise as the other falls, suggests a broader, more systemic unease. This isn't just about one asset acting as a safe haven. It's about two fundamentally different assets responding in unison to a perceived increase in global risk. The implications of this synchronized behavior are profound. It suggests that investors are seeking safety and stability across multiple asset classes, perhaps indicating a lack of clear direction or a pervasive sense of caution regarding traditional financial markets and geopolitical stability. The common narrative often posits that Bitcoin's volatility makes it a risk-on asset, contrasting with gold's risk-off nature. Yet this recent trend challenges that simplistic view, implying that in the current climate, both are being treated as refuges from potential economic headwinds. This could be driven by a multitude of factors, including persistent inflation concerns, ongoing geopolitical tensions, and the unpredictable nature of central bank policies worldwide. The market may be signaling a flight to quality that encompasses both tangible, historical safe havens and the emerging digital equivalent, reflecting a complex risk assessment by a broad spectrum of market participants. Furthermore, this correlation could influence investment strategies moving forward. If both assets are indeed reacting to similar macro signals, it might necessitate a reevaluation of portfolio diversification. Investors might need to consider how to balance exposure to both traditional and digital safe havens, understanding that their performance might be linked in ways not previously anticipated. The market's reaction to this synchronization is still developing, but the consensus among many observers is that it underscores a period of heightened caution and a potential for significant economic shifts in the coming year. This is a developing story that will undoubtedly shape investment decisions and market narratives throughout 2025. Hold on tight, because the market signaling is getting even more complex. Next, we're diving into a fierce ideological battle that's tearing the Bitcoin community apart. Is it money or is it data? You need to hear this. Bitcoin's identity crisis. Money versus data fuels community divide. The very essence of Bitcoin is under intense scrutiny as a fundamental ideological split deepens within its community, centering on its core purpose. Is it primarily a monetary system or a versatile data storage tool? This debate has been significantly amplified by the upcoming Bitcoin Core V30 upgrade, which proposes to remove the 80-byte limit on the op-return opcode, a move that allows for the embedding of larger amounts of arbitrary data onto the blockchain. The implications of this technical change are far-reaching and have ignited a passionate discourse. Proponents of Bitcoin Core argue that removing the data limit fosters innovation, enhances user freedom, and allows the network to evolve with modern technological capabilities. They believe that the blockchain should not be artificially constrained, and that users should be empowered to utilize it as they see fit, provided they are willing to pay the associated transaction fees. This perspective champions a more open and adaptable blockchain, capable of supporting a wider array of applications beyond simple financial transactions. Conversely, a significant faction, often associated with the NOTS client, views this change with alarm. They contend that expanding the blockchain's capacity for data storage fundamentally undermines Bitcoin's original mandate as a secure, decentralized monetary system. Critics warn that this could lead to increased network congestion, higher transaction fees for monetary transfers, and the potential for the blockchain to become a repository for non-financial data, effectively diluting its value proposition as digital gold. Advocates for NOTS emphasize the importance of maintaining Bitcoin's financial neutrality and preventing spam transactions that could degrade network performance and scalability. This camp prioritizes the integrity and efficiency of Bitcoin as a peer-to-peer electronic cash system. The divergence has tangible consequences. Adoption of the NOTS client has reportedly grown, capturing approximately 17% of nodes by mid-2025. This growing support for an alternative implementation raises concerns about a potential network split, reminiscent of the contentious SEG-WIT fork in 2017, should consensus fail to materialize. The situation is further complicated by warnings from prominent figures like Cabra, a maintainer of Bitcoin.org, who suggests that if Bitcoin Core fails to foster effective communication and consensus, NOTS could eventually supplant Core as the reference implementation. Such a shift would represent a monumental ideological and governance change for Bitcoin, potentially altering its trajectory and perceived identity for years to come. The community is at a crossroads, with the October 2025 release of Bitcoin Core V30 serving as a critical juncture. The debate highlights a fundamental question: should Bitcoin remain a strictly financial settlement layer, or can it embrace a broader utility as a data platform? The outcome of this ideological battle will not only shape the technical roadmap of Bitcoin, but also influence its long-term adoption and its place within the broader digital asset ecosystem. This internal debate is crucial, but the external view of crypto is also shifting dramatically. Next, we're comparing the institutional appeal of Ethereum ETFs against Bitcoin ETFs and analyzing the macro forces at play. ETFs in focus. Ethereum challenges Bitcoin's institutional dominance amid shifting macro narratives. The landscape of institutional investment in the digital asset space is experiencing a significant evolution, with a growing focus on the comparative appeal of Ethereum ETFs versus Bitcoin ETFs. As macroeconomic uncertainties persist, the narrative surrounding institutional adoption is subtly but surely shifting, potentially altering the flow of capital into crypto-backed financial products. For a considerable period, Bitcoin ETFs have been the primary focus of institutional interest, largely due to Bitcoin's status as the first and most recognized cryptocurrency, often positioned as a digital store of value. The approval and subsequent performance of spot Bitcoin ETFs in various jurisdictions have demonstrated a strong appetite from traditional finance for regulated exposure to the asset. These products have seen substantial inflows, indicating a growing acceptance and integration of Bitcoin into mainstream investment portfolios. The narrative has largely been about Bitcoin's potential as an inflation hedge and a long-term growth asset, bolstered by its limited supply and increasing adoption. However, the conversation is broadening to include Ethereum. As the second largest cryptocurrency by market capitalization and the backbone of decentralized finance, DeFi and non-fungible tokens (NFTs), Ethereum presents a different, yet equally compelling investment thesis. The recent advancements in its network, particularly the transition to proof-of-stake, PoS, and ongoing upgrades aimed at improving scalability and reducing transaction costs, have enhanced its appeal. The potential for Ethereum ETFs to offer exposure to a platform driving innovation in smart contracts, DeFi, and the metaverse is becoming a key talking point for institutional investors looking beyond just a store of value. This comparison is particularly relevant in the context of macroeconomic uncertainty. When markets become volatile or uncertain, institutional investors often reassess their strategies, seeking assets that offer not only potential returns, but also diversification and resilience. While Bitcoin is often seen as a hedge against inflation and systemic risk, Ethereum's role as a foundational technology for a rapidly growing ecosystem of decentralized applications positions it as a growth-oriented asset with significant long-term potential. The debate now is whether institutions will continue to concentrate their crypto allocations in Bitcoin or diversify into Ethereum, recognizing the distinct value propositions each offers. The success of Bitcoin ETFs has paved the way for greater acceptance of crypto-related financial products. This existing infrastructure and market familiarity could provide a strong tailwind for Ethereum ETFs once they gain regulatory approval and launch. Analysts are closely watching how these two asset classes are perceived by institutional players, as the allocation decisions made now could set the stage for market dynamics for years to come. The interplay between the established narrative of Bitcoin as digital gold and the burgeoning potential of Ethereum as the Internet's foundational layer will be critical in shaping the future of institutional crypto investment. While institutions are navigating these complex narratives, the price action for Bitcoin itself is demanding attention. Now, let's break down the latest price predictions and see if a major rally is on the horizon. Oversold signals ignite debate. Can Bitcoin rally to $114K? Bitcoin, BTC, is currently navigating a period of consolidation, trading around the $108,400 mark following a week of choppy price action. Investors and analysts are closely watching key technical indicators, weighing whether the current oversold conditions could indeed catalyze a significant relief rally, potentially pushing the price towards the crucial $114,000 resistance zone. Recent technical analysis reveals a mixed picture for Bitcoin. On the daily chart, the asset has displayed a pattern of lower highs and lower lows throughout August, a classic indicator of persistent selling pressure. This bearish momentum is further underscored by heavy trading volumes on red candles, suggesting strong conviction from sellers. Analysts are particularly cautious, noting that a decisive break below the $107,000 support level could signal further downside, potentially opening the door to more significant losses. Examining shorter timeframes, such as the 1-hour chart, reveals the formation of a descending triangle pattern. This typically suggests a continuation of the prevailing trend, with weak volume accompanying upward price movements, indicating that buyers are struggling to gain control. Furthermore, Bitcoin's inability to sustain levels above $109,000 highlights the risk of a bear flag formation, which could lead to a sharp decline if the $107,500 support is breached. Despite these bearish technical signals, several oscillators are hinting at a potential rebound. The Relative Strength Index, RSI, for Bitcoin is hovering near 38, and the stochastic indicator is at 10. Both levels are traditionally associated with oversold conditions, suggesting that the asset may be due for a short-term bounce. Similarly, the Commodity Channel Index, CCI, reading of -118 also flashes a short-term bullish divergence. If these indicators prove accurate, Bitcoin could indeed experience a relief rally, targeting the $114,000 level. Fundamental catalysts continue to support a bullish long-term outlook. The April 2024 halving event significantly reduced miner rewards, tightening the supply of new Bitcoin. This supply squeeze is occurring concurrently with accelerating institutional demand, evidenced by the substantial inflows into U.S. spot Bitcoin ETFs. BlackRock's IBIT ETF, for instance, has amassed over $57 billion in assets, and projections suggest ETF holdings could reach 7% of Bitcoin's circulating supply by year-end. This institutional adoption is a powerful bullish narrative. Moreover, data from Bitcoin Whale alerts indicates that large investors are steadily accumulating coins, and long-term holder balances remain at record highs. This accumulation trend signals growing confidence in Bitcoin's role as a hedge against inflation and geopolitical risks. However, macroeconomic factors present headwinds. Delayed interest rate cuts by the Federal Reserve and escalating global uncertainties, including trade disputes and geopolitical tensions in the Middle East, have dampened overall risk appetite. These broader market conditions could temper any potential upward momentum for Bitcoin in the short term. Forecasts for September 2025 remain divided. Some analysts predict Bitcoin could surge towards $200,000 by year-end, with September potentially serving as a launchpad if the $114,000 resistance is overcome. Others suggest a more conservative target of $125,000, $128,000 if key support levels are maintained. Conversely, more cautious outlooks warn of potential deeper corrections, with some charting models suggesting a failure to reclaim $95,000 could prolong a bearish phase. Algorithmic forecasts predict a modest rise to around $116,622 by late September. Ultimately, the coming weeks are critical. A confirmed daily close above $114,000 could signal a bullish reversal, while a failure to hold above $107,000 risks accelerating a downtrend. For now, consolidation between $105,000 and $115,000 appears probable, with ETF inflows and whale accumulation providing a buffer. So, the charts are giving mixed signals, but the underlying fundamentals are strong. That wraps up our deep dives for today. Let's hit you with a quick recap of all the major stories. And that's a wrap on today's critical updates. We saw Bitcoin and gold moving in lockstep, signaling potential macro uncertainty. Then, we explored the intense ideological split over Bitcoin's future as money or data, with a potential network split looming. We also compared the institutional narrative between Ethereum and Bitcoin ETFs, and analyzed whether oversold signals could push Bitcoin towards 114K. Don't miss out on future market-moving news. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, and drop a comment with your thoughts. Follow us on all social platforms to stay connected. We'll see you in the next one.